Recent headlines have suggested that the bill may be smaller in scale. The Fed is unlikely to reverse course on its accommodative policies. Inflation risk may be skewed to the upside, an important consideration for the Fed going forward. Economic growth should be re-accelerated in 2021. Rising COVID-19 cases present the opportunity for a soft spot to begin the year, but may prove transitory. We forecast 4 to 4.5% GDP in the United States and expect global growth to be at 4.5 to 5%. This is the best line. A swoosh-shaped recovery characterized by a quick, sharp decline and then a partial snapback followed by gradual recovery is the most likely scenario in our view. The rollout of a COVID-19 vaccine is needed to lift up the heavily impacted segments of our economy, such as the service industries. A soft spot in the U.S. dollar environment may persist amid the backdrop of a dovish central bank policy, continued budget, and trade deficits. Stocks should see modest gains in 2021, and a strong earnings rebound could allow stocks to grow into their current valuations. We see the S&P 500 fair target value at around 3,850 to 3,900. In 2021, with potential for further upside if the production of the vaccine exceeds expectations. Growth style stocks may continue to perform well next year, but we expect participation to broaden, which could boost cyclical value stocks. Early cycle positioning and prospects of a strong earnings rebound may provide a tailwind for small caps. We maintain our preference for emerging markets equities over developed international, given their strong growth prospects of the region. Bonds will present a more nuanced challenge for investors as interest rates rise amid the backdrop of economic recovery and normalization of inflation. Our target range for the 10-year Treasury is between 1.25 and 1.75. With modest return expectations for high-quality bonds, we recommend suitable investors consider positioning for a rising rate environment. We prefer an overweight in mortgage-backed securities and investment-grade corporates for suitable investors. We believe 2021 could provide similar market performance as 2020, particularly if the progress on a vaccine exceeds expectations. Although we sincerely hope the path will be much smoother than it was in 2020. Markets are forward-looking mechanisms, and as we further receive clarity on what the world may look like after this pandemic, we expect markets will reflect this. Those are prepared remarks from LPL, and I have one slide that Pete's going to put up. This is an interesting, some interesting stats. Mark Twain said, "History doesn't repeat itself, but it sure may rhyme." And that's what this does. I don't know if people can see, but the November 2020 that we just had, one of the best months in a long time. And this is what happens after a 10% gain, monthly gain. It's kind of interesting. On average, if we have a 10% or more monthly gain in 6 months, the average return of the S&P 500 is 11.6, 11.5, and then in a year, the average is 13.1 of the S&P 500 from that month. And that's happened. You can see the percent return, 81% times that's happened a positive. So it's kind of interesting stat to show everybody. And that's all I have. You can chat any questions. I appreciate it. Rick Stites, thank you.
All right, last but not least, we have Tom O'Sullivan, a principal at Yo and Yo.
Good morning, everyone. As Andrea said, I'm Tom O'Sullivan from Yo and Yo CPAs. Certainly appreciate the opportunity to talk to everyone, although I'd much rather be at somewhere on a Wednesday evening at a bar sharing a beer or face-to-face in some way, shape, or form. but I do appreciate the opportunity. I'm going to try to share my screen. I'm not a Zoom expert by any stretch of the imagination, so hopefully this works. And if it doesn't, someone will let me know. So I've been asked today to talk about a few things. Number one, the PPP loan forgiveness, and then some tax planning for year end. And also we'll talk about a little bit with the new president and some of the new tax rules and laws that he's been floated out to everyone. So this is the agenda: PPP loan forgiveness, when to apply, how to apply. A hot topic now is the tax consequences of forgiveness. We'll also touch on, which isn't on the agenda, but the EIDL loan, and a little bit about that one. Then we'll do a tax update, some year-end strategies, tax changes, and looking forward. So PPP loan forgiveness, what you need to know. First, before I start on that, we can recall back in March when this whole thing started, the government threw out very quickly these PPP loans, completely new program, run through the SBA. All the rules associated with it were brand new. And I'm sure you all remember, those who applied and anyone in the banking industry, it was the Wild Wild West. No one really knew exactly what we were getting into, except for that there was money to help keep your business open, your business running. The money was available, the rules on how to get it, and then that the loan would be forgiven if you followed the rules, and the forgiveness would not be income. So those were the general rules that we knew about. And so our advice to our clients, and I think a lot of you got this advice from other places, was to apply for the loan. You may not need it, you may need it, but if you follow the rules, the loan should be forgiven. And even if it wasn't, it's a 1% loan, which, as Ashley can attest, doesn't come around very often. So even if you couldn't get it forgiven, a 1% loan is a pretty good loan. So we helped everyone, and people went through the application process with any bank that was able to loan this money. It was run through the SBA, which was pretty much ill-equipped to be able to lend this much money in this short of period of time, not by their fault, but they've never done that before. But it all worked out. People got their money, businesses got their money, and we knew what rules we were dealing with. So now we fast forward to December, November, December, and we're ready to get these loans forgiven. So what do we need to do to get these loans forgiven? A big question is, when do you file for forgiveness? Doesn't matter when you file. And honestly, at this point in time, it doesn't really matter when you file for forgiveness. Many banks are open, many lenders are open and open their forgiveness applications. They've started to accept applications, and honestly, we've had quite a few clients who have gotten their loans forgiven already, and directly through the SBA. Some financial institutions have been waiting because we do expect more guidance to come out on exactly who needs to apply. Is there going to be automatic forgiveness? That sort of thing. So some lenders have been waiting, but almost every lender has provided some sort of resources to help prepare your forgiveness application and what you need to do. Really, your forgiveness application can be filed at any time before the maturity of your loan. So it doesn't have to be now. It doesn't have to be within 10 months, but it's recommended that forgiveness be submitted within 10 months of the end of the cover period. Otherwise, your payments start. So if you don't apply for forgiveness before then, you may be making payments before your loan is completely forgiven. Talk a little bit about expenses eligible for loan forgiveness. I think everyone who's received a PPP loan has a pretty good idea on what expenses are eligible for forgiveness: wages, paid time off, health benefits, retirement plan contributions, mortgage interest, rent, both on building and equipment, and utilities, water and sewer, electricity, phone and internet, gas, transportation. All these things are eligible for forgiveness. There are some specific rules on rent, and if it's a related party rent. And so if you have that situation, just know that there's some specific rules related to related party rent and being able to be forgiven. So this is a big item here is the covered period, the timeline for determining the eligible expenses. When the loan first came out, it was 8 weeks. You had to do all this within a 2-month period, 8-week period, spend this money, make sure you follow the rules that were in place within this 8 weeks. And it was a rather tight eight-week period. And then the government realized with businesses being shut down, it's very difficult to spend that money within that 8-week period. So then they allowed for either 8 or 24-week period. And it's not in between, it's either 8 weeks or 24-week period that you have to disperse the funds. What we found is that if you use a 24-week period and hopefully you've been open in some way, shape, or form in those 24 weeks, that it's very easy to get this loan forgiven. You would have spent all of your money generally on payroll, and even if you do have some reduction in forgiveness, that you have enough eligible expenses to get 100% of your loan forgiven, and that's what we're really seeing with this 24-week period. So there are 3 different forms to be able to use for forgiveness. There's the 3508 EZ. It is an expedited process. There's shorter forms. There's less documentation required. You must meet one of the requirements. So there's listed 3 requirements there that you have to meet in order to use the EZ form. Pretty much a lot of our clients are able to use the EZ form. There's also a 3508S, which is for loans under $50,000, mostly for self-employed individuals. Simplest form, the least amount of documentation. Basically, you sign the form saying that you followed the rules and you spent it properly, and then you can be eligible for the forgiveness. Then there's the 3508, the long form, the original form that came out. If you're not eligible for either of the other forms, you are required to use the 3508. You must include calculations for full-time equivalency, wage reductions. You must report every employee cash compensation and hours worked. If you've seen this form, you know it's a very, very cumbersome form. A lot of moving parts on it. A lot of documentation required. And so just know it's not a form that you can have a cup of coffee, sit down, and figure it out within a short amount of time. It's a long, cumbersome form. So what do you need to file for forgiveness? The documentation. You do need your original PPP loan disbursement documentation. You're going to need payroll reports for the covered period and also the look-back period. There's a measurement period that you need payroll reports for, payroll tax filings, documents verifying retirement and health insurance, documents verifying interest, rent, and utility payments. So these are all going to be PDFs that are uploaded into hopefully a portal that your lending institution has for you so that they have all these documentations. You're going to need it. It's going to have to be an uploadable form, PDF form. And a big thing is all the documents must be retained for 6 years after the loan is fully repaid, either forgiven or repaid. And that's a big one. Just because you've got it forgiven, you've got the notice from the SBA that your loan is forgiven, doesn't mean that everything's said and done and you can get rid of all that documentation. Keep it all together. In the rare instance, honestly, that the SBA is going to come and ask for that back to make sure that everything was on the up and up and that you should have gotten that loan forgiven, you're going to need to keep that for 6 years. If your loan is entirely forgiven, there's no payments necessary, but keep the forgiveness documentations for your record and support. If you have a portion of your loan forgiven, so maybe not all your loan is forgiven, the PPP loans carry 1% interest rate. There is no prepayment penalty. So if you didn't get your whole loan forgiven and in 6 months you're back up and operating, running 100%, and you don't need the money, you don't need the loan, you can pay it back at any time. Loans have a maturity date of 2 or 5 years, and the payments begin 10 months after the end of your covered period. So this is, again, a hot topic item. What does this mean for my taxes? So the first bullet point, forgiveness is not taxable. That technically is true still. The forgiveness is not income. Normally, debt forgiveness or cancellation of debt is considered income for tax purposes. The way it was written into the law that Congress wrote it in is that PPP loan forgiveness would not be income. Of course, the IRS came and said, okay, well, you wrote that into the law, so we'll follow that. But if you have debt income that was forgiven and you're not treating it as income, then the expenses can't be deducted. In the eyes of the IRS, that is double dipping. You're not treating it as you've got this money, you don't have to pay it back, you're not treating it as income. Okay, well, then we were not going to allow you to deduct the expenses. And this came out after the fact, obviously, after we all got our loans, after we all followed the rules, we paid our employees, we paid our rent, we kept open, we did exactly what the government wanted us to do with this money, and it's going to be forgiven. Well, now the IRS has came and said that the expenses related to this are not deductible. In other words, it's taxable income to you. So this is what we're dealing with now. The IRS kind of doubled down and a few weeks ago issued Revenue Ruling 20-27, which said, basically, really, we're not kidding. If you get this loan forgiven, you cannot deduct expenses related to this forgiveness. When this first was floated out, we thought, okay, if the loan isn't forgiven until 2021, can we deduct those expenses in 2020 still and then deal with it in 2021 and kind of kick the can down the road? This revenue ruling from the IRS said no. If you reasonably expect your loan to be forgiven, even if it is not fully forgiven by the end of 2020, and you cannot deduct the expenses related to that forgiveness. And if you do deduct the expenses because you don't expect it to be forgiven, and then it is forgiven in 2021, you have to go back and amend your 2020 return and basically pay tax on those expenses. So that leads back a few slides to the fact that it doesn't really matter when you get your forgiveness. If we fully expect it to be forgiven, and most we do, these loans, then as it stands right now, today, December 9th, we cannot deduct the expenses related to this forgiveness. So the IRS, as I said, in our industry, we kind of think they doubled down. They said, listen, we're not kidding. This is exactly what we're doing, and this is how we're going to do it. And so Congress, you need to figure this out and pass something that says these expenses are forgiven. Congress has come out and said, well, the true intent of this was not to make this taxable, but in order for that to happen, they're going to have to pass something that says the expenses are deductible. Whether they will or not, some in the industry think they will. My personal opinion is, not the opinion of Yo and Yo or anyone else, is that they will do something once this word gets out. Some businesses, some of you got some rather large loans, again, did exactly what you were supposed to do, paid the people you were supposed to pay, kept your businesses open if you could. If you couldn't, you still paid people, you kept them off the unemployment rolls, and yet now you're going to have to pay tax on that, especially if you're a flow-through entity, pay tax on your personal return. So we're hoping to hear something, but as of right now, this is the way it stands, that you cannot deduct the expenses related to that forgiveness. Before I get into the tax update, I just want to touch a little bit on the EIDL loan, the EIDL loans. Again, back in March, when all this was coming out, the SBA, the government declared disaster loans. Basically, the whole country was a declared disaster area. These EIDL loans, economic injury disaster loans, have been around for a long time. They're run by the SBA, and generally they're for areas we think about, hurricanes, major flooding, fires, some natural disasters that really harm businesses, close businesses, and then these business owners can apply for these EIDL loans. Well, once they declared basically the whole country, because of this pandemic, a disaster area, these made these loans eligible, and a lot of businesses went and ran and got these loans. Again, great interest rate, 3.75%, payable back over 30 years. So if you were eligible for these loans, you could get them, and they were really honestly good loans. We had quite a few clients who did get them, plus the $10,000 that was related to these loans. It was a grant. It was whether you got the big loan or not, you could get this $10,000 and you didn't have to pay it back, that $10,000. Real quickly, I don't want to get too much into the weeds, but that $10,000 that you got as a grant reduces your PPP forgiveness by $10,000. So if you got that grant and you got a PPP, you are going to have $10,000 that you're going to have to pay back through the PPP program. But again, these EIDL loans, the big difference is that the SBA does actually, if it's over $25,000, they secure it by the business assets, and they file a UCC filing to secure your business assets. So what this does, and many people didn't realize until we're all reading the fine prints of these loans, is it pretty much tied up your business. You need SBA approval to sell an asset, to add any owners, to sell your business, to do anything with your business assets aside from cash in normal operations. To do anything outside of normal operations, you need SBA approval if you have this EIDL loan. So if you did get one, just know that there's some restrictions on you. If you didn't use it and you don't think you need it, our recommendation is to pay it back to get those restrictions off of you. But just know if you did get this EIDL loan that there are some restrictions related to that. So now we can go up to some tax updates, what you can do now. It's not too late to do some tax planning. We are finding that many clients that the year has been okay. It's been pretty good. You've tightened your belt. You made some tough decisions, and you're sitting with taxable income, and what do we do? So some ways to reduce tax liability for 2020. If you're a partnership, S Corp, C Corp, there's still bonus depreciation. Basically, any personal property, any furniture, fixture, equipment that you purchase between now and December 31st and put in use, we can write off 100%. Bonus depreciation. There's some net operating loss things that they added to. If you do end up with a net operating loss for the year on your taxes, we can take that back now 2 years that you had taxable income. Change in accounting method. If you were always an accrual accounting taxpayer, and maybe now we can do cash basis, that's something to look at. If you're an individual, retirement contributions, that's always one. Maximum contributions to your retirement plan, SEP, IRAs, etc. This QBI deduction, I know a lot of you are flow-through entities. Qualified business income deduction is still there. So there's ways that's basically 20% deduction off of your taxable, off of your income from your qualified business. That is still there, and that's something that takes some planning, takes some looking into, but that was new in 2018 with the TCJA. It's still around, something to definitely look at before year end, ways to do that. Some changes that happened in 2020 with everything going on. The government threw quite a few, with the CARES Act, quite a few tax changes. One of the big things they did to try to help charities is when they raised the standard deduction with the TCJA, it pretty much eliminated a lot of itemized deductions for people. And one of those things was charitable contributions. So they've determined in 2020 that even if you don't itemize, you can get a $300 above the line deduction for your charitable contributions. So if you've been in the habit of the last few years not keeping track of that because you took the standard deduction, you said, it's not even worth it, make sure you keep track of your charitable contributions. We can take $300 above the line, whether you itemize or not, for charitable contributions. And for those who are very charitably inclined, usually there's either a 50% or 60% cap on the deductions for charitable contributions. The IRS said this year, because income may be low and they still want people to give to charities, that you could deduct 100% of your income if your charitable contributions reach that limit. a little late now, but I know we have clients who take their required minimum distributions in one lump sum at the end of the year. They waive that requirement, so you are not required to take your required minimum distribution from IRAs and other retirement plans in 2020. Check with your financial advisor and your tax advisor before you do that to make sure it makes sense for you. A few other, as we kind of mentioned, for businesses, some things that they change in 2020. If you have a net operating loss, either created in 18, 19, or 20, you can carry that back. That is new with 2020, so it's the thing to look at if you've done that. Depreciation for qualified improvement property. If you're improving your office, if you're improving your building, we can depreciate basically 100% of those improvements, which is relatively new to be able to do that. For your business, if you're a C corporation, charitable contribution limit was raised from 10% to 25%, and there's some business limit interest limitations that they adjusted to from 30 to 50%. So again, another unusual thing that happened this year is, of course, everyone knows we had a very contentious election that just happened, and I guess maybe still isn't completely finished. But President-elect Biden, during his campaign, came out with his tax rules, his tax laws. We usually don't talk much about these because what happens in a campaign generally, probably most times, doesn't necessarily happen once that candidate takes office. But we thought it'd be prudent just to talk about a few things that President-elect Biden has come out with during his campaign. Some unique things. Impose Social Security payroll tax on wages above $400,000. So currently the limit is $137,300. Once you hit that cap in your wages, you no longer pay Social Security tax on those wages. And so now one of the things that he's proposing is that we leave that 137, but then if your wages go above 400,000, then you start paying in Social Security tax again. So there's a gap between 137,000 and $400,000. Know that, most people say, that won't affect me. If you're a flow-through entity and you're a business and you're taxed as self-employment income on that, and you have a really good year, that may hit you. So just be aware of that. One of the very interesting ones, and that's going to have some far-reaching ramifications, is the elimination of the step-up in basis. So what this is, generally, if someone passes away and you inherit their, let's say, stock, for instance, at the date of death of that person, the basis in that stock gets stepped up to fair market value at date of death right now. So if you inherited those stocks and basically sold them right away, you'd have very little or no gain on the sale of those stocks. What President-elect has proposed is eliminating that step up in basis. So in other words, you carry the basis of the stock that you've inherited and make that a taxable event. Very big. The details aren't out on that, but keep that in mind for estate planning purposes. It could be a major issue if he gets this passed. One of the big things too is increased tax for high earners on capital gains. Right now, as we all know, there's capital gain rates are separate from ordinary income rates. And basically what President-elect has said is that he wants to eliminate those capital gain rates, special rates, and make them taxed at ordinary income based on a certain income level. Limitation, or raise the top tax bracket from 37 to 39.6%. Does it affect a lot of people? Yes, it does affect a lot of people, honestly, especially if you're a flow-through entity and have a good business year, or if you have some major capital gains or something. The rate from 37%, 39.6% is a big deal. Limitations on itemized deductions. This is the comeback. He's talked about reducing the standard deduction, but then on itemized and reducing the $10,000 cap on state and local taxes, but reinstituting this limitation on itemized deductions. Phase out of qualified business income deduction, that one we talked about a few slides ago, where it's now 20%. There's discussion that he wants to phase that out, and probably will happen. Increased child tax credit, which would be a good thing. The discussion is from $2,000 to $3,000 per dependent under the age of 17, which would be a good thing. And then creation of first-time homebuyers tax credit. This was around a while ago, and he's talked about reinstituting that for first-time homebuyers, maybe spur the real estate market, maybe help with that. On the business side of it, the one big thing for C corporations, increased corporate tax rate from 21% to 28%. We think this will happen, that this has been a target of the Democrats for a long time, is the corporate rates increase from 21 to 28%, which will make a pretty big difference. He wants to have additional tax credits for workplace retirement savings plans and expand the residential energy credit for businesses. So I packed a lot into a very short period of time. If there are any questions, you can get a hold of me in the chat. My email information is on here, or within Bragg, I know my email information is there. Be happy to answer any questions that anyone has on any of this. Thank you.